What's going on, YouTube family? It's your boy Mike Macklin, aka Money Mike, the financial Thanos. Because I'm snapping my fingers and I'm turning your financial problems to dust. Hey, I want to welcome you guys to another episode. Hope you guys are having a great day. Each and every Monday, what I do is I drop is what's called Money Monday. Now, what I do typically is, I'll drop a money tip or today what I'm going to do actually is I'm going to drop a news article that I read and kind of provide my insights on it, just to hopefully kind of get people in the right mindset. Right now we're in the middle of, well, not in the middle of, we kind of been in this thing for about a while here for this pandemic, but a lot of good and bad things have kind of happened as a result of it. But today, what I want to do is I kind of want to use and this article that I came across to kind of, give people a mindset adjustment when it comes to these good times and bad times. See, a lot of people, and the reason I did this article is because a lot of people, when they look at things like investing, they look at only the negative sides of it. They look at the risk involved. They look at the possibility of losing money. They look at the timing of it wrong. They trying to time the market. They're doing a lot of things the wrong way, and because of this, oftentimes more than not, they lose more than they win, and that turns a lot of people off. Now, Robert Kiyosaki kind of talks about investing in a sense of you have to look at investing more so in a sense of control. The more control you have over something, the less risky it is. But I don't want to get too far off into a whole bunch of different ideologies on it. I kind of want to just get straight to the article. We'll read the article. So, because I don't want to try to commit this article to memory. I just kind of glance at articles, see what captures my interest, and then I share them with you, my audience. Hopefully you guys enjoy this. I want you guys to hit that like button for me, subscribe to my channel, and just keep watching your boy, because I'm out here just trying to put out some great financial news, some great financial information. But without further ado, we're gonna go ahead and check out this article here. Let me get my screen shared so we can so you guys can see this, because again, I want to read this. I don't want to just try to commit it to memory. So the title of this article, it was actually written today at about 5 o'clock this morning. It's rising interest rates are a good sign for stocks. Now, a lot of people, they'll read that and be like, wait a minute, what are you talking about? So this is why I wanted to jump on here and read this article to you. I may skip a few parts, but I probably won't, just because I don't want to leave out anything. So let's get into this thing. So basically, it's saying history says rising rates are bullish for stocks. The recent bout of volatility in the bond market has investors concerned about what a sustained rally in interest rates could mean for stocks. Rising interest rates mean rising borrowing costs, which doesn't sound great for stocks. Also, higher yields arguably make stocks more attractive as an investment, which doesn't sound great for stocks either. And so it's not too surprising to see stocks trade lower in the past months as yields have surged. However, financial markets are a bit more complicated than that. And it's the case, that there are plenty of sound reasons to be bullish even in a light or higher rates. Demand for stocks is strong. Lower stock prices belly robust demand for the asset class. Equity mutual fund and ETF inflows have totaled $163 billion since the start of February, the largest 5-week inflow on record in absolute dollar terms and third largest in a decade relative to assets. Goldman Sachs David Costin observed on Friday. Even though the recent backup in rates has weighed on equity prices broadly, the pace of inflows into equity funds during the last few weeks has accelerated compared with the start of the year. This isn't some historic anomaly either. History shows that equity funds generally experience inflows when real rates are rising, Costa added. During the past 10 years, the most favorable backdrop for equity fund inflows has been when both real rates and break-even inflation were rising. This is intuitive given that the dynamically this that that excuse me, this is intuitive given that The dynamic typically occurs when growth expectations are improving. Furthermore, Costin forecasts massive equity inflows from households and corporates, which both were hoarding cash during the most worrisome periods of the coronavirus pandemic. We expect households will be the largest source of equity demand this year. Accelerating U.S. economic growth has been the most significant driver of equity prices by households during the past 30 years. He said corporate demand for shares is driven primarily by net buybacks, which is calculated as gross buybacks less share issuance. Buyback authorizations totaled $126 year to date, 50% greater than the same time last year, and the largest total at this point during the year on record. Costa estimates net equity demand of 350 billion dollars from households and 300 billion dollars from corporations this year. History says rising rates come with higher stock prices. From our perspective, rising interest rates can mean the bond market is correctly anticipating future economic growth and staying ahead of inflation, things that typically benefit stock prices. BMO Capital's Brian Belsky said to Yahoo Finance on Wednesday, a closer inspection of the data reveals that investors should welcome, not loathe, higher interest rates if history is any sort of guide. In a recent note to clients, Belsky observed that during 7 prolonged periods of rising rates since 1990, the S&P climbed at an average annual rate of 15.1%. The economy is recovering because earnings are going up, the fundamentals are improving, Belsky said. So of course interest rates are going to go up. All that it all that is to say that one worrisome variable like rising interest rates is no reason to think stocks should fall, especially when you can argue that variable is moving for other bullish reasons like an economy that's perking up. Okay, so let me stop sharing my screen here and let's kind of get into this. So a lot of interesting points was brought up, and I'm gonna kind of look over at my phone here while I'm talking about this. So first and foremost, is getting into the historical aspects of when interest goes up and what that means. When interest goes up, the way I look at it is much like when how Warren Buffett looks at a lot of things. And what he says is, you kind of got to do the reverse of what most people are doing. So what that means is, okay, we saw it earlier in the week, a lot of stock prices was going down. And most people respond to that by selling off their stock because they're like, okay, hey, I'm losing money, I'm losing money, I'm losing money. When in reality, you're not really losing money until you actually sell. That's when you either win or lose, is when you sell. So during those downturns, most financial advisors, most economic advisors, most people will tell you, hey, this is not the time to get rid of your stocks. This is the time to kind of look at it as, hey, now you can buy more stock because now the price is lower. Okay, so that's one thing to look at. Now also, the demand for stock is strong. With everything going on, like most investors when they see the markets going down and they see different economic indicators, they start licking their chops. They when you get scared, they get greedy, and I'm one of those people who understand that philosophy and I agree with it. Is because again, you don't when buying stocks, what you don't want to do is you don't want to buy it at the highest price. That's what most people do. They'll see that it's going up, going up, going up, going up, and say, oh man, I got to get in on this. That's not when you buy a stock. You want to buy a stock when it's undervalued, meaning, when it's at a lower price and you expect it to go up. You don't want to buy it just because you see it going up. You want to kind of look at some things and understand that, hey, look, you got to think the opposite of what a typical person might think. A typical person, again, is going to say, hey, look, I see it going up. Oh, that's great. I'm going to buy some. But what you're doing is you're overpaying for that stock. You get it when it's down low, okay, and ride that puppy up. And again, as you become more experienced and you understand the indicators, then you'll know, hey, listen, it's not about timing the market. It's about, hey, look, if you looking at a stock, you've been looking at a stock, you kind of want to, pick that time when you feel it's undervalued, and you get in on it when it's going up. Okay. So don't let things like, downturn um, get you scared. And that's really the main point of what I wanted to talk about here. And let's look a little bit more into this. Um, they're talking about, hey, look, and I know this for a fact is going to happen when those stocks start to go down. The demand for them are going to go up because now you can get that stock at a lower price. And people, again, that understand how history works, over all these down periods, and that's another point that was brought up. During all the down periods that have happened in history, the economy ends up going back up even higher. So if you look at this from a long-term standpoint, then you stand to win in the long run. And this is why a lot of people stay in the market for years and years and years. And when you're investing, that's something else you have to understand as well. Investing is for the long term. Investing isn't a short-term thing. So if you want to do something short term, you may want to do something like trading different stocks and indexes and things like that. You don't want to invest. So trading is probably something more that will work better for you. And what trading is basically saying, hey, I think the price is going to go, at this point, you get in at the lower point, you get out at the higher point, and you come out, or you get in at the higher point, come out at the lower point, and that's how you make your profit. And that's something you can do, daily. That's something you can do. Like what I do is when I do trade, I trade maybe, an hour at the most, an hour worth of work. You can walk away with a good amount of money. And that's also a good way to hedge your money. So I'm saying all this to say, hey, look, when these different economic indicators come out, like the interest rate going up and things like that, most economists and things like that will tell you, hey, look, these are signs that, hey, look, yeah, it's going to come down a little bit, but historically, it always comes back up higher. So this is when you got to start looking at this and saying, hey, oh, this might be a good time to get in on some of this. Look at your favorite company. Maybe you're a huge Apple fan, or maybe you're a Microsoft fan, Amazon fan, whatever. And you see these prices coming down. Look at that as an opportunity that, hey, maybe it might be time to doggone get some of this good old money. And speaking of opportunities, I want to give you the quick opportunity to smash that like button if you haven't already done it. Hey, leave a comment below. What do you guys think? What do you guys think when you see, interest rates going up? What do you guys think when different economic indicators come out there? Because again, typically when interest rates go up, people start borrowing less because again, the interest rate is a little bit higher. They start borrowing less. They start hoarding money. They start doing all these things. But again, what do you think? What do you think should happen, or what do you think you should do? We're getting a lot of good news right now. Um, President Biden is working to pass the 1.9 trillion dollar stimulus package that's going up to the House, I believe, tomorrow. So there's a lot of optimism in the market behind that as well. So again, when you look at investing, you can't do it from an emotional standpoint. You have to look at historically. You have to look at the data that you're presented, and you have to make a intelligent decision. But again, to make it easy for yourself, what you may want to seriously look at is just, hey, get yourself into a good ETF, which is an exchange traded fund. It's like a basket of a bunch of different stocks and things like that. And this is a good way to kind of minimize your risk, while at the same time you're diversifying your portfolio. You got your money in different things, so maybe one thing may come down, but other things are going up. So, that's just free game, quick game for today. I wanted to drop this video just to, again, get you guys paying attention to what's going on financially. And don't let um, bad information or a lack of understanding make you run away from something that can be life changing. Like I tell you guys all the time, I call investing buying your time back, because what you're doing is basically you're allowing your money to grow without you having to work for it. And that's what the game is all about. That's what financial freedom is all about. Um, and I teach this all the time in my coaching, in my training. If you're interested in learning more about my financial freedom coaching and training, hey, I want you to visit me at the link below, www.moneymike313.com. You should see that on your screen here shortly. And, hey, set up a 30-minute appointment with me. Quick, easy 30-minute appointment. We'll go over your financial goals, talk about some things with you, and get you on the right side of this money. Hey, I hope you guys enjoyed this video. Again, smash that like button, hit the subscribe button, hit that notification bell so you'll know every single time I drop a new video. This has been Money Monday. Every Monday, look out for me to, drop an article or something. That's just something lately that I felt I wanted to put in front of the people, is just look at different articles and kind of give my thoughts and insights on it. Hope you guys enjoyed it. As always, I love you. God loves you. He smiles when he sees you, and he sees you all the time, so he's always smiling. So why aren't we? Hey, you guys have a great one. Thank you so much for tuning in. Enjoy the rest of your day. Like, leave a comment below of your thoughts. Subscribe, share this, and y'all, I'll see y'all on the next one. Gone.
Damn, I ain't been broke in a minute. Damn, I ain't been broke in a minute.